Good day, ladies and gentlemen, and welcome to our class sponsored by LegacyFX on Elliott Wave Principle. Now, today's class is brought to us by LegacyFX, one of the world's leading providers of Forex and CFD trading. Legacy is a regulated provider, so if you can't access our site, it means they're not regulated in your home country. Now, when you trade with Legacy, you get access to the MetaTrader 5 platform, the world's leading and most respected trading platform brought to you by MetaQuotes. It is a powerful platform. It covers all financial charts, gives you advanced charts and technical indicators. It's a user-friendly indicator interface and can be used on any personal computer, Mac, smartphone, mobile device, and you also have access to their web browser. So you can download the MT5 desktop platform for the most professional trading environment possible, or you can just simply log in using any internet computer connected to the internet once you have a username and password. Then, of course, you can download the app and put it on your Android phone or your Apple device on any iOS device that you have. By using the MetaTrader 5, you can actually build your own black box system because MetaTrader 5 allows you to use their MQL5 to build your own trading strategies. So if you like, during today's class, you can go to www.legacyfx.com and click on the Open Demo account. There's no credit card required, and you can download their MetaTrader 5 demo account and start trying out their advanced tools, start using their charts, start checking out their platform, and start trading in a demo mode. Because at Legacy, they believe that what they want to do is cut through all the excessive jargon and provide financial content in a language that is comprehensive to all. They want to make everything easy for you to understand. They don't want to disguise everything and make it overly complicated. They offer competitive trading conditions, a full array of free trading tools. They're fully complied and regulated, and they offer simple and easy execution from banks around the globe. They're also a world leader in trading knowledge. They have a wide range of tutorials and courses. They offer live webinars like we have today. They have all types of market research and analysis. And you get your economics calendar, you get your glossary, you get all the calculators, everything you need to trade. And now all their traders get the AutoChartist scanner, which is one of the most well-known, well-respected third-party providers for understanding and predicting what is happening in the marketplace. Now, since Legacy is a regulated provider, I must give you a risk warning. So I would appreciate if you could read what's on your screen, and then we'll get moved on with today's webinar. But remember, trading carries a lot of risk, and you should always understand the risk or seek independent advice. Now, today's class is being recorded, and if you wish to see a recorded version of today's class, you can do so by using the same link used to come to this live class, and you'll be able to access the recorded version in about 24 hours. Or when investing.com has had time to edit and clean it up, you'll be able to find it on the investing.com website under the education tab, where you signed up for this class, and then under webinars on demand. And in fact, there you can see all the webinars we've ever presented in the last 7 years. So let's start talking about Elliott Wave and the Elliott Wave principle. Now, I'm going to try to make this simple. Of course, Elliott waves, or waves as we call them, are always done on financial charts. Everything done on a financial chart falls in the field of technical analysis. Now, I renamed technical analysis and I call it chart analysis. Okay, so that takes a less scary look out of everything. But Elliott waves is a way of interpreting price movement or understanding what a trend is doing. So before one can begin to identify the types of patterns Elliott discovered and the rules that govern them, it's a good idea to first learn about labeling of wave degrees. Counting waves is a skill that comes with practice and proper application of the rules described. It is a good idea to start applying a wave count to a market you are familiar with and update it from time to time as you practice. Now, my personal philosophy on waves, trends, price action is that price, which is controlled by the human psychology, price doesn't move up and down by rules. Price moves based on traders all over the world, buyers all over the world, sellers all over the world, users all over the world, coming to a price that they're willing to buy or sell for. And it can change in moments. And that human psychology is what stops us and stops automated systems and black box systems and robotic trading from being right all the time. If anybody could really predict what the market was going to do and where it would be, they would have done it. And they'd have these black boxes and robotic systems, and everybody that had them would be making a fortune. But it doesn't happen because human psychology is not predictable. So if you believe, like I do, that price is completely random and that nobody can predict price successfully, but there are certain times that price exhibits non-random behavior. When we get these non-random movements, which in most cases are known as trends, uptrends or downtrends, we can then apply certain things to these markets to make sense of it. Now, Elliott developed Elliott waves in the late 1920s. That's a long time ago. And by discovering, and so it was really only the stock market. And he thought in this chaotic, random fashion that he could find repetitive cycles. Now, Elliott discovered that these market cycles resulted from investors' reactions to outside influences or predominant psychology of the masses at the time. He found that the upward and the downward swings, hence trends, of the mass psychology always showed up in the same repetitive patterns, which were then divided into patterns he termed waves. So in essence, what Elliott was doing is he was breaking down price movement when it was trading in a trend. Because as we know, markets can go in an uptrend, they can go in a downtrend, and they can go sideways. Most of the time, they're somewhere in this method, or they're somewhere in that method. But when they are moving in identifiable trends, we can then apply certain theories. Now, Elliott's theory is somewhat based on Dow theory. Although Dow theory wasn't really around at that time. Dow theory was just about becoming to, Charles Dow was just introducing his idea of Dow theory. But based on this is that the markets and prices move in waves. And because of the fractal nature of markets, however, Elliott was able to break down and analyze them into much greater detail. So when we see price moving in a nice uptrend, we can say we have an uptrend. Dow had theories about how much an uptrend would retrace itself. Now remember, up until this point, there was no such thing as technical analysis, no such thing as mathematics in the markets. We didn't have computers for sure. And we traded based on hunches, ideas, and some fundamentals. But we didn't have many fundamentals. We didn't even have TV in the 1920s to tell us what was happening. We sure didn't have easy access quotes. We sure didn't know that Google was doing something in China. You know, so the markets moved at a much slower pace because news reached out to people in a slower fashion. Now, how would a guy in Montana or a guy in Paris get the news about a US stock because the railroad just added a branch on, or increased its passenger load, or got a new locomotive? It would take a long time before that information would flow. So the markets moved in a much easier fashion. But fractals are mathematical structures which, on an even smaller scale, infinitely repeat themselves. Elliot discovered stock trading patterns are structured in the same way. So what Elliot decided to do was to find a way that by looking at price and price movement, which everybody had access to as price, could take in account all that random information that was coming to different people in different markets at different times. And between Elliot and Dow, we had a whole new way of looking at markets. Elliot made detailed stock market predictions based on a unique characteristics he discovered in the wave patterns. An impulse wave, which goes with the main trend, always shows 5 waves in its pattern. Now, this is what waves and the Elliott wave patterns based on is these 5 impulse waves, and then a reversing set of A, B, and C waves. Okay, I have a personal problem with it as I can't even see them. And then every move you can break down to more waves, and in a smaller move you can break down to smaller waves. So it's like trying to break down the waves in an ocean. Sure, I can see that big wave the surfers are all looking at, but then it's going to see those little ripples it's making to see the ripple to how that flows all the way over to the little pond and makes that little wave. I don't see them in my trading. Now, I understand them, but because it's something that I don't see, it's very hard for me to use them. I completely believe in cycles and waves, and I completely believe in trend lines. So hold on, let me pop up some charts that got these on there for you, so you kind of can understand what we're talking about. Now, this is Elliott waves placed on a chart. And the reason we have the big red A, B's, and C's, and then we have the smaller A, B's, and C's, and then we have the smaller 3, 4, 5, because these are subwaves within bigger waves, within smaller waves. And it, to me, gets extremely confusing. Now, I can identify by looking at a chart prices that were significant. But my question is, why do I have to break them down to waves? But that's not meaning they're not true and good. It's just meaning there's lots of things I don't use. Okay. There's lots of things other people use because you have to find what works best for you, what you can see. When I teach you chart patterns, I'm a firm believer in triangles, but I'm not a believer in the different types of triangles. And I'm a very firm believer of eyeballing support and resistance, where I don't use Fibonacci's. Doesn't mean they're good, bad, or indifferent. But the fact is also, when I try to teach them, I can only teach you I can teach you the basics, but when I don't use something, I can't teach you the little intricate details, but I'm going to try. And I have two little presentations I've got put together for you that'll help also. But here we can also see the waves, the impulse waves, okay, which are A, B, C, and then we can see the larger waves, which are the A to B, the B to C, the C to D. Okay, and then we break it down to the smaller A, B, C's, and then the 1, 2, 3s, 4s. So again, it's like seeing a wave within a wave within a wave. Now for me, this is my chart. See, I can see, because I believe in trends, and I can see the trend line. I can see the push, the ease, the push, and the ease. Each time price moves up to make a higher high, eases back down to make a higher low, pushes back up to make a higher high, then eases back down. And I I just don't get or grasp. It's not that I don't grasp. I don't believe in the 5 wave theory. Okay. I don't believe the 5 and the 3, but that doesn't mean it doesn't work. So there are 2 types of waves. There's the impulse wave and the diagonal wave. So now we're going to look at both of the waves in a bit more detail. Okay. And then you see, you also have to learn the, the rules that go with each wave. And see, this is the thing that I don't really get, because I can't force price to do anything in particular. So if it means that a wave doesn't follow the rule, does it get thrown in the trash can and we have no waves? So in impulse waves, which are the push, ease, push, ease, push, ease, which are the 1, 2, 3s, and 4s, the basic rules are, okay, that wave 2 cannot retrace more than 100% of wave 1. Well, what happens when it does? Wave 3 can never be the shortest wave of the 1, 3, and 5. And wave 4 can never overlap wave 1. So doesn't mean I throw it all in the trash can. These rules are unbreakable. If one of the rules is violated, then the structure is not an impulse wave, and no one would need to relabel, and one would need to relabel the suspected impulse waves. So does that mean I throw it all out in the trash can and I have nothing? This is what I don't get when price is moving in a trend. Okay. So in the majority of cases, impulse waves will exhibit what is called an extension to their normal pattern. This means that one of the impulse waves' 3 motive subwaves will be elongated impulse wave, the exaggerated subdivisions. This can happen of either wave 1, 3, or 5, and it typically happens if only one of the waves. Okay. Wave extensions are not easily identified. If you run into difficulty seeing the extended wave, try your best to label the overall impulse on the wave. A small guideline may help with the situation. If the potential wave 1 and wave 5 of the larger degree impulse wave looks equal, then most likely it's a wave 3. So here, let me share you with this little presentation that's probably going to do a little bit better job than I'm doing right here, explaining it all to you. And then we're going to go on and talk about using Elliott waves in your everyday trading.
Elliott wave theory. Elliott wave theory was developed by Ralph Nelson Elliott in the 1930s. Elliott believed that markets generally did not behave randomly and in fact traded in repetitive patterns. Let's now take a look into Elliott wave theory and how it is applied to the Forex market. Elliott theorized that trends in financial prices resulted from market participant psychology. He found that swings in mass psychology always relayed themselves in recurring fractal patterns or waves in the financial markets. Elliott's theories resemble another theory we will talk about in future known as the Dow theory. Both theories recognize that prices move in waves. Elliott, however, additionally recognized that the market had a fractal nature. Fractals, which we have discussed previously, are mathematical structures. On a small enough scale, they infinitely repeat themselves. Elliot identified that price patterns were also structured the same way. From this, he then tried to find a way that his repeating patterns could be used as a leading or predictive indicator. Elliot derived detailed stock market predictions based upon the reliable characteristics he discovered in the wave patterns. In this example, we have an impulse wave. It travels in the same direction as the larger trend, and there are always 5 waves within the pattern. Next, we have a corrective wave. This travels in the opposite direction of the main trend. Within the Forex market, where the price moves up or down, it is always followed by a correction or a opposite movement. Trends show the main direction of prices, while corrections move against the trend. These examples are 2 waves that represent both movements. Let's now take a closer look into the impulse and correction waves. The impulse wave has 5 waves moving in the direction of the overall trend. This is followed by 3 waves moving in a correction against the trend. This is 2 waves made up of 5 and 3 moves. They then become the 2 subdivisions of the next higher wave move. Look at the following example made of the 8 total waves we have discussed. The impulse wave labeled 1 to 5 and the correction wave labeled A to C. The 5-wave impulse will in turn go on to form wave 1 at the next largest degree, and the 3-wave correction will go on to form wave 2 at the next largest degree. The properties of the corrective wave normally have 3 distinct price movements. 2 of the movements are usually in the direction of the correction. These are counter-trend, and 1 move will travel in the direction of the trend. Similarly, in waves 2 and 4 of the impulse wave, these are corrections against the trend. So to summarize this information so far, waves are formed by the market movements. They are defined by their behavior. The entirety of an impulse wave and the correction wave together can form the beginning of a larger degree wave. How do we know we are seeing a wave in progress? As always, there are rules to the identification of waves. The impulse wave. Wave 1. Wave 1 is not always apparent at first. When the first wave of a new bullish market begins, fundamental and technical outlook is usually entirely negative. The previous trend has not given us enough information to consider that it is about to reverse. Sentiment is usually still bearish at this point, and remember, Elliott wave is rooted in psychology. Wave 2. Wave 2 is the correction of wave 1. It can never extend beyond the beginning of wave 1 or it becomes invalid. Prices retest the previous low. Bearish sentiment can quickly increase as people anticipate the downtrend may continue. However, volume is generally lower than seen in wave 1. If we were to measure the retracement, it's very common that it doesn't go beyond the 61.8% level when using a Fibonacci retracement tool. Wave 3. Wave 3 is usually the largest movement in the wave in a trend and can generate the largest yield in pips. This can vary in different markets, such as commodities, where wave 5 is sometimes the largest. The fundamentals now are more positive and prices begin to rise quickly. Smaller corrections usually are short-lived and shallow, and opportunity to now get involved on a pullback is limited. It is often at the midpoint of wave 3 that the market participants begin to change their sentiment and heavily get involved in the buy side. The bullish trend is now becoming certain. Wave 3 often extends beyond wave 1 by a ratio of 1.618 to 1. Fibonacci shows its hand again. Wave 4. Wave 4 is the second corrective move. Prices may stall and move sideways for an extended period. Wave 4 typically retraces less than 38.2% of Wave 3. We see volume levels well below that of Wave 3. This can be a good opportunity to buy in the pullback when expecting the potential rise for Wave 5. Wave 5 is the last phase in the direction of the now dominant trend. News is almost universally positive and bullish outlook is almost universal. Volume is often lower in Wave 5 than Wave 3, and we begin to see divergence on momentum indicators. Despite market participants still entering buys, the move is now complete and the correction wave is anticipated. The correction. Wave A. Corrections are generally harder to identify than impulse moves. In Wave A of a bear market, the fundamental news is still positive. The behavior seen is similar to that of the beginning of Wave 1. We may see increased volume and possibly a turn higher in open interest. Our video explaining open interest is a very good lesson in regards to this. Wave B is the correction. Prices reverse higher. Some participants will see this as a resumption of the bull market. Technical analysts may see the peak as the right shoulder of the head and shoulders reversal pattern. Fundamentals are probably getting worse at this point, but not entirely negative, and volume during Wave B should be lower than in Wave A. Wave C. Prices move steadily lower, volume increases, and the bear market is now confirmed. Wave C is typically at least as large as Wave A and often extends to 1.618 times Wave A.
So remember, hold on, let me get your screen back here. There we go. When markets move against a trend, they do so with an apparent struggle. The resistance prevents the pattern that forms from developing a motive type of structure, and the patterns and form are more varied than in the motive wave. There are two styles of corrective waves, the sharp correction and the sideways correction. So that's the A, B, and C. The sharp correction moves steeply against a trend of of a higher degree, and a sideways correction appears to form a flat type of structure that goes back to the price where it began before ending the correction. So please keep in mind that although corrections are often seen as a declining in price, the reality is that the market can correct up or down depending on the type of the trend of the higher degree. Now we also have zigzag correction. A simple zigzag is a three-wave correction structure that is labeled A, B, and C. Then we have the flat corrections, and we have the expanded flat corrections. So markets do not always form the relatively simple patterns. The structure is often complex and confusing. The way Elliott wave categorizes these structures is what is called a combination. A combination is composed of the corrective wave seen above and seems to be a corrective wave's way of extending sideways for the most part. Combinations are mostly sideways types of corrections that can zigzag. The structure is labeled with a WXY for a double correction or a WXYXY. So this is why I'm saying I don't use Elliott waves, because it means you have all these rules, but then it can be this, it can be that, it can be. I just want to do price analysis, and I want to see the general waves, the push and the ease, the push and the ease exhibited in a trend. So supposedly, we have three very specific rules to trade by. One, wave 3 can never be the shortest impulse wave. Wave 2 can never go beyond the start of wave 1. And wave 4 can never cross into the same price area as wave 1. Now, if you were drawing a trend line and your trend line was holding, none of those three things would happen anyway, because then your trend line would be invalid. So these are basically, they call them rules, but they're guidelines. And a guideline is not a hard, fast rule that can't be broken. It is a tendency, something that happens so often that it can almost qualify as a rule, except for the times it doesn't work as expected. The guidelines described are useful ways of applying Elliott wave analysis that have shown their validity over time. But as they are not rules, they may not work out every time. So there's the guideline of equality that says that two of the motives subwaves in the 5-wave sequence will tend towards equality. This means that when wave 3 of an impulse wave is the extended wave, that wave 5 will approximately equal wave 1. So then we have the guideline of alternation. And then we have the guideline of depth of correction waves. And you have to know all of these inside out, and they're so intricate. Then we have the guideline of channeling. And then we have projection. There are three ways of channeling that can be used for projecting the end of waves, but they are all used the same technique. They both require 3 points, beginning and ending of a wave, to create their channels. Hence, we're just building a channel. One technique of projecting the end of wave 3, one technique for projecting the end of wave 4, and one technique for projecting the end of wave 5. Then we have guideline 6. That's the guideline of scale. It's really a technique of looking at the market and is often applied when creating channel projections. So wave personality is the reflection of mass psychology acting in the markets. The emotion that flow from optimism to pessimism creating the structures we see in the market. The personality of each wave type is the same whether it's a higher degree wave or a lesser one. Now, please keep in mind that we have basically 8 wave cycles, 5 pushes up and 3 corrections. Put A. Okay. Now, I have no problem with 1, 2, 3, 4, 5. Push and ease, following a trend line. This is where I have a personal problem. I don't believe necessarily you're going to end at wave 5. We can always say, okay, well, we have a longer wave. It's too subjective. But then we go into impulse wave A, corrective wave B, and then impulse wave C. So putting Elliott waves to use will take some practice. It takes a whole bunch of practice and a whole bunch of rules and a whole bunch of guides and a whole bunch of, because you give me enough rules and enough guides, I can always find some reason something didn't do this, something did that instead. It's like listen to Donald Trump. He always has some way to explain something far out there. And when it doesn't happen tomorrow, he can give you some other excuse. So if you persist in applying the rules, eliminating non-conforming counts, and looking at the personality of the waves you're accounting, you will find satisfaction applying Elliott wave theory. You will prove to yourself that the market indeed does conform to these patterns and that there is a meaning behind them. You will often find that it is necessary to adjust the count you made to conform to new data. Don't get frustrated by having to adjust. It paves the way to a more accurate wave count and helps to refine your skill. This is something that is expected in doing Elliott wave analysis as a skill. And applying it comes through practice. Now, we didn't discuss every nuance here because it goes on forever and ever and ever. But let's take a look at how we might combine Elliott wave patterns in some sensible, easy manner and add them with Fibonacci levels to use in a trading strategy. And let's take a look at my little presentation. We're going to go back and then talk about it a wee little bit. Oh, now, and by the way, if you look on your screen, hold on a second. Okay, yeah. If you look on your screen under handouts, I've given you a handout that's called Technical Analysis from Investing.com. There's nothing you have to enroll in, nothing you have to do, nothing you have to pay for, nothing. You just click the download button and it's a PDF. It'll be downloaded to your computer. This is a great resource guide. And it discusses all of technical analysis and has a section on waves and cycles. But you can use this as a resource guide, but it's only available in the live class. So let's look at combining Elliott waves and fibs and see if we can use this in some sort of manner to make sense of our
where we're at in terms of the wave count can help us understand how to approach making money on the stock. So when we're looking at the very beginning of a trend, we're down here and the stock's going up a little bit, down a little bit, up a little bit, down a little bit, and then it breaks out and initially sets what is called a wave 1. So once the stock breaks out of neutrality, this is now what we call wave 1. Now at the end of wave 1, it is going to establish a resistance zone. And what resistance is it's always above the stock price and it drives the stock back down in price. It's basically the area on the chart where, you know, traders, hedge funds, institutions, you and I, we're all locking in profit because the probability is now for the short term for it not to continue to go up. The probability is actually for it to start coming down. Now here we draw our Fibonacci. And what we want to draw is we want to draw the entire motive wave. So this wave 1, this is called a motive wave. So now I've clicked on a Fibonacci retracement tool, and over here you can see percentages. The standard retracements that typically occur in the market are a 38, a 50, or a 61% retracement. A 21% retracement certainly can be considered a retracement. However, I see these more as a high base type pattern than I do a retracement. I'm looking for the stock in terms of when I want to buy. I want to buy it after a 38 or a 50% retracement. That's what I consider my zone. That's that strike's coming right down the plate, the pitch down the middle, and I'm going to pick up that big old bat and hit a home run. I don't mind a 61% retracement, but anything under 61, I automatically start thinking something else. I automatically start thinking, oh my goodness, is this reversal? Oh my goodness, is this some other type of movement that I was not anticipating? So I tend to shy away from anything that drives past the 61% retracement level. So now the stock will drive down into its 50% retracement, and once it starts going back up, once again, that's called confirmation. That is confirming that we now have support. It is now time to buy. So now I'm going to draw what is called a Fibonacci extension to help me understand where wave 3 will go into. And wave 3 is the longest of the wave counts. There's a lot of reasons for this, but think about it like this. Once the stock breaks out, it's not in the news a lot. You're not getting a lot of information. It's not getting upgraded. None of this. But once it's been in a trend for some degree of time frame, you're all of a sudden you get this news out there, you get this information out there, and it's like, oh my goodness, and it drives all the way up to 161, and then at 161, people start to once again lock in profit. And as you can see there, we're going to now draw our Fibonacci retracement tool, and then the next retracement is back down into the 50% retracement again. Wait for it to go back up, and it's time to, everybody say it with me, buy. It's time to buy, because now, the stock is telling us, hey, listen, this is a really good moment in time. We should get out there and make some money on it. Now go ahead and draw your Fibonacci extension tool. And now, because this is the longest of the wave counts, we are going to see what is called slowing momentum, and it's going to drive into the 61.8% range. Now that it drives into the 61.8% range, we're now going to once again lock in profit. And we're going to lock in profit because you don't have any more probability, and it's going to retrace once again into the 50% range. Now, in looking at understanding all of this, we love retracements, we love breakouts. But when you're at the beginning of a trend, because you have so much more time left in that, you can approach that stock in a lot of different ways. You can position trade, you can invest, you can, start writing covered calls against it, you can sell naked puts against it, you can, buy options a little bit longer term and whatnot. But when you start getting into the tail end of the trend, you are really kind of limited in your approach as a trader, instead of, investing here, because really, what can I expect? I can only reasonably expect for the stock to come back into resistance, because we're at the end of the trend. Now, I'm not saying that a reversal is going to form. It certainly could form a continuation pattern, break out, and start it again. But again, I don't know what the probability is any longer. So here, if I'm a buyer right there, I'm going to be a seller right there, which means I'm going to swing trade it. If I'm a buyer right here, I'm going to swing trade this up into right there because I don't really have it. But if I'm a buyer back here or here, I can be a little more aggressive. I can be a little more, I can give my stop losses a little bit more room. I can hold the trade through longer. I can approach it in a lot of different ways. And it's just because you're at the beginning of a trend versus at the end of the trend. So once again, this approach, technical analysis in general, but an Elliott wave Fibonacci's, understanding where we're at in the trend, can help us determine the style of trade and the type of trade. It can also help us understanding how aggressive or conservative we want to place stop losses. And it is absolutely, vital in understanding where to target. If I'm a buyer right here going into wave 3, I'm going to be very aggressive on my target at 100 to 161 Fibonacci extension level, versus going into wave 5, I'm going to be a little more conservative. I'm going to do a slowing momentum target, versus coming in at the end of wave 5, I'm just going to target the previous areas of resistance, ladies and gentlemen. So once again, Matt Justice from Tax.
So as you can see, there are ways that we can add or interpret price trends by using Elliott waves. And like I said, in the simple wave 1, wave 2, wave 3, wave 4, wave 5, which I call the push and ease, push and ease, push and ease of a trend line, of the life cycle of a trend. Now, Elliott waves goes back to you can have an Elliott wave cycle which goes back all the way to mid-century. That's called a super cycle. And then you can break it down from there into multi-decades, and that's called a super cycle. From there, you can bring it down to a 1 year or several year, so what you've got is you've got this grand super cycle with super cycles inside, with cycles inside, with a primary inside, with an intermediary wave pattern inside, with a minor wave, with a minute wave down to the minute waves, all the way down to the sub-minute waves, which takes you all the way. It's a wave within a wave within a wave within a wave within a wave. Okay. If you want to become an Elliott wave specialist, it's one way to trade. Like I said, using Elliott waves in the basics, 1, 2, 3, 4, push, ease, is a good thing. And you will tend to see that wave 3 is usually the strongest wave, and understanding which wave you're in a trend line will help you make better decisions and help you understand when you should be conservative and when you should be aggressive, what point to move your stop losses, where you should be taking profit. Okay. So there is some benefit to the basics of Elliott wave, okay, that you can simply apply into your everyday trading. And then, like I said, if you want to become an Elliott wave specialist, go all the way down into it. But it all depends on your personality, what you're looking for, and how you would break down and see all of these cycles within cycles within cycles. So thank you very much for joining us today. Please click on that download button. Like I said, it's free, but you can only get the Techno Analysis Guide in the live class. And thank you very much for joining us, and have a great trading week. And if you have any questions, go to www.LegacyFX.com, click on their live chat button, or send them an email, and a financial analyst will give you a call or send you an email and be glad to answer all of your questions. Thank you very much for joining us, and have a great trading week now.